Hello, and let's get started. Welcome to our webinar, and we're excited to have you here, and we have a great turnout today. Thank you for taking the time out of your day to join us. We partnered with the Options Industry Council, or OIC, to bring you this webinar today on income-generating options strategies. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and InvestTrade. I'd like to go over some quick logistical items with you. The session today will last approximately 1 hour. All attendees on this call are muted. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box on your screen, and our speaker will address those at the end of his presentation. We ask that you not use the chat room for questions or use the raise your hand feature, as our speaker won't be able to see those. But we do encourage any and all questions and that you just enter them in the Q&A box at any time during the presentation. You can also reach out to our trade desk at any time if you have additional questions after the webinar. We're happy to help. And for those of you just joining, we'd like to welcome you to our webinar on income generating option strategies. And to tell you just a little bit about eOption, as our name implies, we're a brokerage firm that specializes in stock and options trading. Our founder was one of the founding members of the Chicago Board Options Exchange and has been active in stock and options trading for over 40 years. He created his ideal trading company that caters to serious traders and those who have a passion for investing. We have some of the lowest rates around. All stock and ETF trades are commission free, and options are just 10 cents per contract plus $1.99 per option trade. In addition to stocks and options, you can also invest in mutual funds and bonds. We also have a few new offerings we recently launched. Last week, we launched a powerful new stock screener where you can search from over 60 different criteria to select stocks that fit your strategy. And we also recently started offering unlimited Zacks free research reports this year, so you can research all your favorite stocks. We also have some tools you may be interested in. We do have our Options Play tool, which is a free online tool that highlights option trade opportunities for you. And it's normally $500 annually, but it's free for all our customers. And we also offer auto trading, where you can have your favorite investment newsletters alerts automatically traded for you at some of the lowest commission rates in the country. And because we support trading education, we recently revamped eOption's YouTube channel, where you can see many videos on option trading, no matter what level of trading you're at. We hope you'll subscribe and check it out. I'd like to turn our attention to our speaker now, Ed Modla, from the Options Industry Council, and we'd like to welcome him back. Ed has been a popular speaker working with us and has over 20 years of experience in the financial industry. And to tell you briefly about his career, he started with Whole Trading Company, where he was an options market maker at the Chicago Board Options Exchange and the Chicago Mercantile Exchange. He then spent many years as an independent trader of stocks, options, and futures. He then went on to MF Global and went into futures brokerage business and then joined RJ O'Brien. In 2014, he joined the Options Industry Council, and he's currently Principal of Investor Education at OCC, which is the Options Clearing Corporation, where he oversees retail education programs. He also has a lead position in the production of options curriculum for the OIC. And so without further ado, we'll get started, and I'll turn it over to Ed Modla. Thank you.
Thank you very much, Gina, for the introduction and my compliments on what you're doing at eOption. It certainly is an awful lot that you offer your customers with respect to research and market analysis, but also the commitment to the options product, and then the unique and what I would say very trader-friendly commission structure that you have. So it's good to be here as always. As Gina said, my name is Ed Modla. I'm 24 years now in the business in one capacity or another. And for the past 6.5 years, it has been strictly education, teaching the options product to anybody that wants to listen. And today's presentation is going to be income generating option strategies. And you can think of income generation perhaps as anytime you're selling options or you're a net seller, which there's quite a few strategies in that category. Think iron butterflies, iron condors, vertical spreads. We're going to focus today's strategies on selling options that incorporate stock in some particular way. And we'll get to those strategies in just a second. First, our disclaimer: options are not suitable for everyone. There will be some examples and strategies discussed today that are not endorsements, but are rather for illustrative and educational purposes only. A little bit about OIC. OIC was founded back in 1992 and under the parent company of OCC. OCC now fully funds everything we do at the Options Industry Council. We are not brokers. We don't have brokerage services or advisory services. We don't sell anything. We just provide free education to the public on our website, optionseducation.org. You can find current and previous courses in written format, audio podcasts, videos, and previous webinars just like this one that we produce in-house every month and record those and put them up on our website. If you're interested in this style of education, on our website under the events section, you can see what's upcoming. My next event will be on July 14th, walking through the options collar strategy. But we do these all the time. And then lastly, our education service desk can be reached by email, options@theocc.com. You can ask us questions about what we have to offer from an educational perspective, or ask an options question to this team. They can't talk about ticker symbols and give you advice on what trade to use, but if it's an educational question about options, the team will do the best they can to help you out. The three strategies that I have today, covered calls and cash secured puts, I would venture to say that all of you are familiar with those strategies and may use them frequently. I will talk those through and at least define those for those who might be new, but offer a lot of insight and commentary about those strategies while I talk through them, and then get to the covered combination, sometimes called the covered strangle. This is one of my favorite strategies to teach, and it's one that doesn't seem to get as much attention as I think it should. And when I do give this class, it is surprising to me sometimes the feedback I get from market professionals and even sometimes from money managers who say, thank you for that. I never really thought about using that strategy and using options in this way. And that just surprises me, because it really is a strategy that I think is useful to have in your toolbox, and it showcases how versatile options can be. Let's go with our first strategy here, covered calls. Arguably the first strategy that investors tend to use when they start to implement options into their portfolio, but by no means is this a strategy for beginners. You might start using covered calls and never stop using them, no matter how advanced or savvy you get using the options product. The covered call is probably going to be there somewhere. And that's what I want to walk through today. First, outlining what it is, but then offering maybe some insight that you didn't think about before. And with the covered call and with the other strategies, I'll just point out up top here, one of the things I want to do here today is take the examples that I have and talk through how you would calculate the annualized return given a certain circumstance, like the stock going up or the stock remaining unchanged. I want to do that because I think that's a valuable analysis for investors when they're comparing trades to one another, or they're making the decision, is this a good trade for me or not? How much option premium am I actually getting here? If you do this annualized return calculation, I think that's one way you can help answer that question for yourself and feel more confident in the decisions that you're making. The covered call starts, it really has two pieces to it, two sides. One is stock, one is calls. The investor writes or sells one or more equity call contracts for each 100 shares owned. And when an investor sells a call contract, they are taking on the obligation to sell or deliver 100 shares of stock. If you don't have 100 shares, then you could not sell a call option and considered it covered. The word covered really means that the obligation you're undertaking is covered by the shares that you already own. If you had 50 shares and you sell the call contract, you are obligated to deliver more shares than you own. That is not covered. By the same measure, if you have more than 100 shares, say 300 or 500, you can choose how many contracts you want to sell, 500 shares, you could sell 5 calls or 4, 3, 2, 1, whatever it is that you choose, and cover some of those shares and leave the rest uncovered. The whole purpose, the entire motivation for doing this strategy is that in exchange for this obligation that you're taking on to sell shares at a particular strike price, you are paid the premium. And this is what it's all about. There's nothing else to consider regarding your motivation and what you're trying to capitalize on with this strategy other than receiving option premium, which does a few things for you. It certainly can increase your returns. It also lowers your cost of capital, lowers your total risk. It improves the likelihood of being successful on this trade. We'll see all this visually in the example a couple slides from now, but the premium is what it's all about. And that's what we mean by generating additional income versus not selling options. This additional income does a number of things for you. Because that's the motivation, this premium that you notice when you look at your options chain and you consider selling the call, you have to evaluate, is this premium enough to make it worth my while to sell this call option? I'm going to take on obligations. Am I getting enough premium that I'm comfortable with? Sometimes the answer will be yes. Other times it'll be no. Undoubtedly, you will run into both of those circumstances. And the answer will be different for each investor. How much premium is worth selling? You're going to get different answers across the spectrum of options users, depending on their confidence level in the underlying itself and their risk tolerance. The more confident you are in an underlying moving higher, the more premium you might want to get for that obligation of selling your shares and giving away upside potential. And that's the final point here. The bullish nature of this strategy, you have to point out that there is risk. Just like there's risk in any strategy, this risk is to the downside. And particularly for those who sell covered calls and they're successful at it, I always want to point out, make sure as you re-implement the strategy, as you continue to use it, that your position reflects your market outlook and doesn't just reflect a position that has been successful a number of times in the past. You have to make sure that every time you reestablish or initiate a position, that it is consistent with your market outlook. Now let's look at a call writer's obligations and talk about these for just a minute. To repeat, when you sell a call option, you are taking on an obligation just as you are when you sell any option. And in this case with calls, it's the obligation to sell shares of stock at the strike price of your choosing, and this will occur if you are assigned. Most often, assignment would occur at expiration if the stock is above your strike. But that's not necessarily always the case. Equity and ETF options are American style. That has nothing to do with geography. There's American, there's European. American just means that exercise and assignment activity can occur on any day up to and including the expiration date of the contract. And in this case, that is the one concern we're going to have with respect to early assignment. It's possible, because these options on stock are American style, to be assigned before expiration, but really the only circumstance when that's likely to happen is when there's an upcoming dividend. In the absence of a dividend, the call holder generally has no motivation to exercise and pay for shares before they have to. There's no need to spend money and incur a debit before you have to. If the call holder wanted to exit their position entirely, again, they don't have to exercise to do that. They can just sell the call. And if they wanted to continue holding their position, they can just hold the call and they don't need to exercise early. But dividends is the one circumstance that can change that, because call holders are not shareholders of record. Therefore, they're not entitled to a dividend payment. If they hold the call and do nothing, and the ex-dividend date passes, the stock price is going to drop, as we all know, by the dividend amount, and that call option would suffer. So there becomes the one circumstance of motivation for a call holder to exercise early before the expiration date. You would want to know that if you're on the other side of this trade with a covered call. Now, again, this has to be, this would only occur for in-the-money options. A call holder who has an out-of-the-money option or even an at-the-money option certainly isn't going to exercise early to capture a dividend. But for an in-the-money option, yes, they certainly could. And if you have long stock, short call, it's in the money. You certainly are at risk of having your shares called away and not getting paid a dividend because you're no longer a shareholder. And once again, in exchange for all of that, it's the premium. It's the premium you're paid up front. That is your motivation. That's why you're doing the trade. And that premium needs to be enough for you to feel that those obligations are worth it. Before I get to the example on the next slide, I'll just speak briefly about strike price because I get so many questions about, why would I sell out of the money? Why would I sell at the money? Why would I sell in the money calls? Now, one thing to point out, when we say covered call, I'll clarify. The traditional covered call is shares are already owned. Maybe you owned them at a much lower level. You're profitable now. You're in a good position, and you would like to overlay a call option. And that's the circumstance I'm gonna take here. Rather than buying shares, selling call at the same time, you're overlaying on an already existing stock position. Out of the money options are going to have lower premium amounts, but would offer the greater potential for maximum gain, because out of the money options means your stock gets called away at higher and higher levels. In other words, if the stock were to rally, the out of the money option is going to offer a higher rate of return because you can make money on those shares until you get to your strike price. As you go lower and lower in strike, you get to at the money, you get to even in the money, your potential maximum gain starts to wane. It starts to fade. The premium you get goes higher. Your break-even point gets better, but your maximum gain on the upside starts to fade. So choosing strike price comes down to how confident are you that shares are going to rally. The more confident you are, the higher the premium or the higher the strike price you're going to try and look for, keeping in mind the premium has to be worth it. Let's look at an example, and this is where I will take these numbers from to do our annualized return calculations. Here we have the shares trading at 75. You own stock at 75 today, and maybe you own them in the low 70s and in the 60s, but here you are today, long 100 shares, $75, and the shares are going up, and you think they're going to keep going up, but you're willing to sell if they get up to 80. But instead of just waiting and watching and seeing what happens, you look at the options market and see, hey, there's some good premium here to sell a call option and take on the obligation to sell stock at the price I'm comfortable with. And I can get paid to do that. So you sell the 80 call, and let's say this goes out 1 month from today, and you sell that option for $1.80, and that's 180 total dollars as we're quoted here on a per share basis. So now your cost is lowered. You have 7,500 in shares. Now you received 180 back. So that's 73.20. At this point now, if you were indeed long at 75, your break-even point is lowered to 73.20. And as we compare this to being a long stock at 75, you can see that the covered call outperforms at the 75 level, gives you a better break-even point. It outperforms in losing territory, and it will outperform all the way up to this intersection. This is going to intersect at a stock price of 81.80. And once you get above that level, the covered call underperforms because the profit is capped while the stock profit keeps on going and going. So the characteristics of this are, yes, you have limited upside, but you outperform long stock in a lot of other areas, and you have a better range of profitability. You've got a buffer to the downside that gives you a greater likelihood of being successful. And generating income in this way is going to motivate you for these reasons: better break-even point, higher likelihood of being successful, and outperforming long stock across a variety of future stock prices. Now, I'll explain one thing further regarding position management. Now, certainly risk is to the downside. If the stock starts to tank, you have to think about whether or not you want to hold this position or close it. If the stock remains unchanged, it consolidates, you decide. Are you comfortable? Do you want to move on? All the while, if you keep a position, you got to still be true to yourself in that you're bullish on the underlying itself. But one thing I want to point out is if you get this big rally, let's say you go up to 90 and you've now had you've got a week left until expiration and the stock's at 90. You reached your max gain here. You still got 7 days until expiration. But position management is what you want to focus on at this point. Once the time value of this 80 strike call has gone to 0, then you cannot make any more money on this trade. If there is time value, then there's a little more for further gains due to that decay. But once the 80 call loses all of its time value, then you have nothing further you can gain. If the stock's at 90 and the 80 call is, let's say, 990 bid offered at 1010, so it's centered right around its intrinsic value of $10, time value here is 0. The 80 put is trading, no bid at a dime. There's nothing left. At that point, you've got all risk and no reward. And that is when you would consider position management. When you're all risk, no reward, maybe it's time to go in, buy back the call, sell the shares, close the position, move on to another trade. But again, just to restate that, it's when the call option loses all of its time value. And you can track that. Stock could be at 85, it could be at 90, it could be at 92. Take a look and calculate what is the option premium, what's the intrinsic value. If there's no time value left, that is when you've reached a point of all risk and no more reward. I want to get to this annualized calculation. I'm going to do that now. And again, I think this description here for me and in my experience in the markets, calculating annualized return before I make the decision to enter a trade is helpful for me to compare one trade to the next. Maybe there's 3 or 4 different trades I'm looking at, and I only have enough money to do one. And I need to pick one of these. How do I compare? Annualized returns is one way you can do that. And what I will do is I will first assume that the stock remains unchanged. And that's the way I look at this. The stock does not move. It stays at 75. If that happens, what's my annualized return? Stock's at 75. We make or lose nothing here on the shares. The call option premium is ours to keep. That's $180. So we would have actually profited $180. To divide that profit by your cost of capital, which is our net debit. Share price minus premium, 73.20. If you do that math, $180 profit divided by the cost of capital of this trade, $7,320, then you'll see that the profit on that trade is about 2.5%. I assumed earlier that this was a 1-month trade, so annualizing that takes on the assumption that you could do this trade over and over again over the course of the entire year. So if it's 1 month and we earned 2.5%, you take 2.5, multiply it by 12, and you've annualized your return, which is going to come out to be 29.5% annualized return. Now that's unrealistic. We know that we will not be able to execute this trade 12 times in a row, back to back to back to back, and get the same result every time. That's not what we're trying to do here, is calculate an expectation. We're trying to calculate a number that lets us evaluate the trade presented to us in the moment. Another trade that we might be considering, we can do the same calculation and compare the two. What's the annualized return of this other possibility? Is it higher? Is it lower? Is there a reason why? Now, the two key details there to make sure you're comparing apples to apples is that other trade you're looking at, you would want to make sure it's the same duration till expiration, so 1 month out, and it has a similar relationship between current stock level and strike price. So this is about what, 6%? 6% out of the money. If you're going to compare directly, you would have a 6% out of the money call expiring in a month. Do the same calculation using option premium and your total cost, and then compare the two. If the other trade is giving a 35% annualized return, then the final question is, what's the risk between these two trades? If you think they're exactly the same, there's no higher risk in one underlying versus the other, and one's offering a 35%, the other is offering you 29.5%, you will lean one way or the other. But that last piece has to be there. Maybe there is more risk, and maybe the 29.5% trade's the better one because it's very conservative and it's very low risk, and you're not getting enough to take on this wild underlying for just a little bit more option premium. I'm going to do more of this annualized calculations as I go through here, but let's get to the cash secured put. And we have entire presentations that we've done on cash secured put. I'm not going to do that here. It's going to make it rather quick because it's a simple strategy with just one piece, but selling options just as you did with the covered call, but in this case without stock. You're just selling an outright put, and that's it, one side. And remember what we're doing when we sell a put option: receiving premium and taking on the obligation to buy stock at the strike price of the put option. Normally, or most often, investors are choosing to sell at the money or out of the money options. Now, when it comes to selecting strike, as a comment across the spectrum of options strategies, there's nothing wrong with having a rigid approach, a rigid strategy that is predetermined. And some investors will tell me they always sell put options that are 3% out of the money, 2 weeks to go, or whatever their criteria is. Or some investors use delta. Right? They always sell 30 delta puts, 1 month to go. If you have that kind of structure and you're comfortable with it and it's working and you like it, there's nothing wrong with that. Another approach, and as an educator, this is the approach that I feel I have to answer, is that every situation could be different. And when I get posed this question about what strike is the best and what strategy is the best, and I'm always deflecting that question because the way I have always approached the markets is I don't know what's the best strike. How confident am I in this underlying? How volatile has it been? How badly do I potentially want to be assigned? I have to think about all of these things. What is the option premium that I can get for various strike prices? If the premiums are higher than I expected, I might feel a little more cautious. What's going on? Premiums are higher. Does the market expect a bigger move than I did? Maybe I'll go down to a lower strike and get a good amount of premium and take on a little more conservative approach. So that's the way I generally answer that question about selecting strike, is consider some factors, including how confident you are in where the stock is going and how volatile it might be, your risk tolerance, the option premium, and then find a place that's comfortable for you. That's a little more complicated than having a strategy that's defined and using it. But I think the latter approach would more often be beneficial once you get comfortable with it and once you feel like you've settled in and you have some experience selling puts. The assignment portion here is potentially welcome and desirable. I've heard both. Certainly investors have said, well, I sell puts on stocks I don't mind owning, but I don't really want them. I'd rather have the put just expire worthless, take my money and move on. And that's fine if that's your approach. In other circumstances, you may actually want the shares. You want assignment, and the shares are trading higher than you would like for them, at a higher level than you want to pay right now. So instead of going ahead and paying for them, you sell a put option and willingly take on this obligation. So either way, it's either welcome, you're okay with it, or you actually want the shares. Either way, you're selling the put, you're receiving premium, that's yours to keep, and you now have this risk potentially of owning the stock and all the risk associated with it. And that's what we'll look at when we get to our example here. Stock's at 146, and for this example, I gave a little further clarity on the numbers I used in the options calculator that we have on our website to calculate the option premium. 30 days till expiration, 25% expected implied volatility at the 140 strike, and you get a $2 option premium. And this might be, say, a stock that's been selling off, or maybe it's consolidating, or maybe there's a support level down at 140, 138. You think it's going to hit that level and test it. So you want to buy shares, but 146 is just too much. Now, one thing you can do is use a limit order and just say, well, I'm going to put in a limit order to buy shares at 140. There's advantages to doing that. The biggest advantage is once the stock gets to 140, you're filled. You're going to get your shares and you're going to be long stock. If you sell a put instead, in one way you can think of it as though you're selling a put, taking on the obligation and getting paid to work a limit order at 140. That's not totally inaccurate. The one word of caution I would say to that is if the stock does make a quick move down under 140 and then rallies back above and keeps going, where the limit order would have been filled and you'd capitalize on the move higher, the put option is probably not going to be assigned to you unless the stock is under 140 at expiration. And so you could miss a move. If the stock were to retrace and then rally back up above the strike, you might never get the shares, and all you're left with is this smaller consolation prize of the option premium. So that's a bit of a comparison between using a limit order to get into shares and using a cash secured put. A big advantage, of course, with the put is you're getting paid. You're getting paid to wait. If the stock consolidates, if it rallies from here, you made a little bit of money. And you also have, if you do get the shares, you have a better break-even point versus having a limit order at 140, getting filled, having your stock there. If you got filled at your strike price at 140, you were actually paid for that. So now you have a buffer at 138. Ideally, in a perfect world, the stock is actually just under 140. And it says 139 and you get assigned. Now you've got stock, your break-even point is 138 and the stock never even got that low. You can go ahead and use a stop order to get out at your break-even point. That's kind of a rare circumstance, but that is as perfect as it can get if you want the shares to actually get them and to have a cost basis below where the shares ever traded. Annualized return here is similar to what we just walked through. You're going to look at, we'll just say the stock stays above 140. It doesn't really matter where it goes. It's unchanged or it consolidates, but it stays above 140, which means our put expired worthless. In that case, our profit is going to be this $200 profit. That's our gain on the trade. And then what is our cost of capital? What did we need to have, or how much capital was tied up for this trade? And that's going to be your strike price, 140. Remember, you're obligated to buy 100 shares there, but you were paid $2. So 138 times 100, that's $13,800. And that's a comparison there. $200 divided by your cost of capital, $13,800. That is about 1.5% return if you never got the shares. This was a 30-day option. So 1.5%, multiply that by 12 to extend it out a full year. Again, that's unrealistic, but to make the comparison, extend that out for a full year, multiply by 12, that's about over 17% annualized return on this trade if you never get the shares, if the stock stays above 140. If you have another cash secured put in mind, you can do the same calculation, keeping in mind 30 days and keeping in mind here, 4+% out of the money that you're going. And if you had that same circumstance somewhere else, you can calculate the annualized return and compare the two, and then further evaluate your opinion on the risk between the two trades. Now let's put these together into what's the culminating strategy here today that I wanted to talk about, and that's the covered combination, otherwise called the covered strangle. And this is a bit more of enhanced income generation. But when I walk through this and I talk through various circumstances of its implementation, what sometimes surprises people is when I outline the situation where this strategy is more conservative than the covered call strategy. And that sometimes surprises people. They don't believe that's the case on the surface. And then when I talk through it, it becomes pretty clear. But yeah, given your circumstance and your portfolio, this strategy could be a more conservative approach than having that covered call or that buy right position that we talked about earlier. Very simply, the covered combo is merging the two strategies that I just talked about, the covered calls and the cash secured puts, merged together into three pieces: long stock, short call, short put. Now we're not doubling up the shares, so it's 100 shares of stock, sell one call, sell one put, willing to buy another 100 shares on the downside, similar to that motivation of cash secured. The cash is there, we might get assigned. If we do, maybe we're okay with it. Maybe we actually want those shares at that level, but the downside looks just like that with the similar motivations as the upside does, which we'll see as I walk through the example. But assignment generally is favorable, particularly if you have a higher maybe account size and the volume you're trading is greater than this lowest denomination of 1. But either way, theta is certainly your friend. This is selling options on both sides of the market. You're selling a call, selling a put. So enhanced time decay, your risk is in the long stock position. More specifically, the stock goes to 0. That's your total amount of risk, the shares you bought today and the shares you may potentially have to buy upon assignment of the put option. Let's put up an example, and I'm going to do one last annualized return calculation for you with this example, and then talk a whole heck of a lot about the covered combination on the following slides. Here's the example that we're going to stick with for the next several slides. Stock's at $65 a share. 45 days or so till expiration. That's where these numbers come from. And we sell a 45-day 70 strike call for $1.50, and we sell a 60 strike put for $1.75, and we own 100 shares from 65. And again, this example is entering all these three together, executing them all at once. You could have 100 shares from earlier from a much lower price, and now they're sitting at 65, and then you overlay these options. It's certainly something you can do. But our example, it's all executed at once. And with strike prices, I want to point out, I went equidistant here from the stock. Certainly does not need to be the case. You can treat your strike selection as separate items. How do you select your strike when you do a covered call? Well, it's how far up do I think the shares might get? Talked about that earlier. How confident am I in a big move? Where do I think that resistance level might be? Once you've identified that, you look at the premium. You say, is it worth it or not? Maybe you have to move the strike down a little bit, maybe not. But you choose that call strike at your liking. Same thing with the put strike. If you were to buy more shares, you know you're under the obligation to maybe buy more shares. If that were the case, where might you want that to occur? And what is the option premium there? They can certainly be at unequal distances from where the stock is currently trading. Let's look at maximum gain. It's the best case scenario, the stock rallies. Remember, we're bullish here, we're long stock. It's going to be a bullish position. If you're neutral or bearish, this is not the strategy for you. But if you're bullish, maximum gain, shares get called away at 70. We paid 65 for the stock. And the premium is ours to keep. Premium from both sides. 325 is ours to keep. This $5 plus the 325 gives you 825 maximum gain. Now, sometimes I like to calculate maximum gain annualized percentages. What's the best potential, best case scenario for me here? And what does that look like in terms of return? It's a little more complicated with this strategy because the capital that's being tied up is a bit more complex than it was earlier. We start the same way, maximum potential gain here, 825. So that's the profit side, the numerator in our equation. But what's the denominator? How much capital are we required to put up to have this position on. So it's 825 divided by what? Well, we can start with these pieces. Let's take a look. We bought 100 shares at 65, $6,500 there. We might have to buy more shares at 60. That's another $6,000 there. That's $12,500. But we were paid $325 up front. So 6,500 plus more capital we have to keep in our account to potentially buy more shares, minus the option premium received. We'll see this number on the next slide, but it's 12,175. There's your calculation on profit. 825 divided by 12,175, just under 7% return on the trade. It lasted 45 days. So if we did this over and over and over again for the entire year, how many times can we do this trade? About 8 times. And then you multiply and get an annualized return. What you'll get is about 54% annualized return. And you can scrutinize that and think about that. When you trade more and more of these, you will get a sense of what types of returns you're looking for. And I can't stress enough that 54% annualized return, that's not something to get excited about, to think, well, I'm going to do this trade 8 times in a row and I'm going to hit max gain 8 times in a row and make 54%. That's not what you're trying to do here, because that won't happen. All you're trying to do is do these calculations so you can compare trades better in your mind, have an idea of what you're looking for. And when you look at option premiums, you will know rather intuitively over time, this is a good number. This is what I'm looking for. I look for 40% or 60% or 80% annualized return. I know I'm not going to make that much, but that's what I look for when I do options. I'm not saying me personally, but I'm hypothesizing that might be something that you determine for yourself that you're interested in looking for. Let's look at the downside of the covered combo example. We have the same trade here up top. The downside's pretty simple. We own stock at 65. We might have to buy more shares at 60, and we received option premium up front. So what's our total cost? Here's that 12,175 number, buying shares twice, and then taking off the premium, and there's your total risk if the shares went all the way to 0. On a P&L graph, it looks a little different, a bit more complex than the other strategies did. But if you isolate the upside from 65, it looks like the covered call. And when you go down here to 60, you'll notice you're long 100 shares, and now you're potentially long another 100. So you have this increased decrease or extensive losses on the downside. And this is what you got to be concerned about. And this is why people, I guess, tend to have a natural tendency to think of this as a more a higher risk strategy than just doing a covered call. It's not really the case. I'll get to that in a little bit. But one thing I want to point out here is, what's the break-even point? As it looks right now, what is our break-even point? We own shares at 65. We were paid 3.25 for options. So right now, our break-even point is going to be down at 61.75. 61 minus the option premium. 61.75 is the break-even. And that's where your profitability kind of tilts. Keep that number in mind, because to forecast, the break-even point is going to change here in just a second. So 61.75. What happens at expiration if, and we'll say if, the stock is below 60? Well, this is not what you want. Ideally, it might be a situation you anticipated, you're comfortable handling, but it's not really what you wanted. Below 60, we're sitting on losses. The shares we've had have now gone into negative territory. We breached that 61.75 break even. Now we have to buy another 100 shares, and we are long 200 shares with a risk profile that's going to look exactly like being long 200 shares of stock. But if you extend this line up, you can see maybe it crosses break even at a different point, and it does. Since we now bought another 100 shares, the break-even calculation is now going to change. Remember back at the previous slide, we calculated that the total net cost would be 12,175. If we are long 200 shares, that's what we would have ended up spending, 65, 60, minus the option premium. If you do that math, 12,175 divided by 200, the break-even point is now going to be just a few ticks under 61. It's around 60.9, a different break-even point than I calculated on the previous slide. And that's one wrinkle of complexity here. If you get assigned, the break-even point on the position is actually changed. Your cost basis on the shares that you own changes. And remember, these options will be gone. If you're assigned, you no longer have the combo. You'll just have a straight line of long 200 shares risk profile. That's an interesting little wrinkle there about how the break-even point changes if you're assigned. In between the strikes, very simple. Both options expire worthless. That's good. That 325 worked in our favor. Our profitability will depend on where is the share price in relation to 61 3/4. So that's where the break-even point will stay. And then you further decide what to do. And the only word of caution, I've said it once or twice, if something works, it is somewhat natural. Investors will tell me that they're just going to do it again. I sold these options for 3 1/4. That worked out well. Maybe the stock's trading here at 64. I'm going to go ahead and sell it again. I'll sell the 70 call, sell the 60 put, bring in another 325. And then you do it again and again because it's working. And I understand that. I've done that myself because something is working. But over time, what I think everyone eventually learns is every time you reestablish a position, it needs to be because you really do believe in the risk profile that you're establishing once again. Something might work 9 times in a row, and then that 10th time blows the whole thing up. And so just make sure you're honest with yourself and what your market outlook is if you do decide to reestablish those positions. On the upside, we have this covered call dynamic where the stock rallied, went above 70. Our shares are now called away. And this is going to be what I would suspect is this is always going to be the preference. Whereas with that cash secured put outright trade, sometimes you might actually want the stock to dip to get shares. In this case, based on my experience in trading this strategy, the return you're going to get off the share price plus the options is going to be very attractive. And you're going to want this to happen. Take my shares away. Go ahead. I made money on the stock. I made money in the options. That return is going to be very good. And if this keeps happening to you over and over again, you're going to have some really good returns in your portfolio. Of course, you don't want the stock to go all the way up to 78 or 80 or 82 because you could have done some things that would have worked out better. But assignment, yeah, that's usually going to be a good thing. A couple of questions that that always come up when I do this strategy that I want to just briefly touch on when investors look at this is they say, well, I don't like this risk down here. Couldn't I buy a put or buy 2 puts down here to cover the risk? And it's a common question when I teach any strategy. An investor will say, well, couldn't I do this? Couldn't I do that? And the answer is always yes. Always yes. You could buy a put. You could buy 2 puts. You can do different things and tailor the strategy to your liking. Now, if you do that, it's not going to be the classic covered combination strategy. It's going to be something unique to you, but it's always something to keep in your mind. I'm going to use the covered combo, but I'm going to do something else a little bit different with it because I want to, because it fits my market outlook and my risk tolerance a little bit better. So yes, you can always do that. I said earlier, I teased earlier that this strategy here can be less risky than the covered call. And I'll keep it on this slide while I talk through that. In this example, we're at the lowest denomination of 100 shares, 1 call, 1 put. And if you compare this to buying 100 shares and selling a call option, then yes, there's certainly more risk here. You need more capital. You might get assigned. You might double your position and have greater losses to the downside. But often investors are dealing with more than 100 shares. Let's say it's 1,000. And let's go back to the covered call, which I'm really defining here as what's known as the buy right, buy shares and sell call at the same time. Buying 1,000 shares and selling 10 calls would be that classic buy right position. With the covered combination, you can do all sorts of things. And I'm going to maybe extend the meaning of the word combination here and say you can combine these pieces in any quantity you want that could ultimately yield your full size position of 1,000 shares. So for clarity, the buy right, buy 1,000 shares, sell 10 calls. What I am not suggesting is that you buy 1,000 shares, sell 10 calls, and sell 10 puts. Obviously, there's a heck of a lot more risk there. I'm suggesting going the other direction and scale down. This opens up so many possibilities. You can buy 500 shares, sell 5 calls, and sell 5 puts. So you've got your shares covered, and now you've sold 5 puts. If you're assigned, you are now going to be at your full size position of 1,000. But think of how many different ways you can combine these things. You can buy 800 shares, sell 8 calls, sell 2 puts. Buy 200 shares, sell 2 calls, sell 8 puts. You can sell different strikes on the downside. You can buy 200 shares, sell 2 calls, and then choose, I'm going to sell 3 of these puts and 3 of those puts and 2 of those puts. You can do all sorts of different things that would ultimately yield, if assigned on everything, the full size position. And if you're doing that with those larger quantities and you're scaling down your shares that you purchased at today's stock price level, then you now would have a position that has lower risk than the covered call would by just buying those, say, 1,000 shares outright. And this really becomes the beauty of this trade, is your ability to do that. Now, you might not want to. When I say lower risk, that also means lower reward. If the stock were to take off and rally higher, you're going to wish you bought 1,000 shares. But if the stock consolidates, the stock moves lower, you've now got a more conservative position because you didn't buy 1,000, you bought 300. And now, based on your put option strikes, you're going to pick up another couple hundred here, another couple hundred there. And eventually you'll get to 1,000 shares. And the break-even point or cost basis, if that were to happen, would be considerably lower than your break-even point or cost basis if you did the buy right. And that's how this strategy can be implemented in a way that scales down your risk and becomes more conservative than the covered call position. The last thing I'm going to say about this is for those of you who pay attention to or look at volatility skews, it's worth mentioning that we are now selling call and put. So across the volatility skew, and I will attempt to draw something here. For those of you familiar with volatility skews, you likely already know that if you were to plot implied volatility, say we have implied volatility over here, and then you've got your strike prices. Down here is going to be strike price. You have this skew where volatility for puts is higher than it is for calls. And I'm going somewhere with this, so bear with me. At each strike price, remember this is now strike price here on this axis, there's a different implied volatility level. And most often, most of the time, not always by any means, but most often puts have higher levels of implied volatility. If you were to do, say, buy 1,000 shares and sell 10 calls, you buy 1,000 shares at 65, you sell 10 calls at 70, you're selling your 10 calls here at this vol level. If you bought 500 shares at 65 and you sold 5 of these calls and you sold 5 of these calls, you're likely going to get more premium for those same 10 options. You're selling 10 options either way. But if you're now including puts on the other side, you sell fewer calls and some of these become puts. And again, you can stagger your puts, sell a few here, a few here, a few here. You will likely be getting more premium for the 10 options that you are selling than if you did the buy right. And that's worth mentioning and keeping in mind for those of you who are looking at volatility. And I should also say, every example I just walked through there involves selling 10 options. You don't have to do that either. You can buy 800 shares and you can sell 6 calls and sell 2 puts somewhere to go full size. But because you're getting a little more premium due to the skew, maybe you feel like, oh, I'm a little aggressive here. Maybe I want to leave 200 of these shares not called away. If the stock really pops, a couple hundred shares can run. And it's another element. We can go on and on and on about different ways, different things you can do. But now that we've got three pieces here together and they're all working in different ways, now this really is when options trading gets fun, it gets exciting, and it works. It's beneficial to you and your portfolio. I'm going to turn it to Gina in just a second, but just to flash up our website again, optionseducation.org. Got a lot of past material there and things we're working on. We always try to put new things up there. And again, there's the email address, options@theocc.com, that you can contact us with any questions you've got. And Gina, I do see there's some questions in here, but I'll turn it to you first to start to wrap things up.
Yes, Ed, thank you so much. If you wouldn't mind just going through the questions now, I see there's about 8 in there. That would be great.
Yeah, I see. It looks like maybe a few of these I did touch on at some point. So a few of these may have come through earlier. What are the best strikes? That's going to be one of two things. Either you've set the strategy, you know exactly what you want to do, and you're always selling 30 deltas, 40 deltas. But by and large, that's going to be case by case. How aggressive are you? How confident are you? What's your risk tolerance here? And perhaps just if you're a technical analyst, particularly, maybe the charts are going to tell you where's the support level, where's the resistance level, where are the moving average levels, where's this channel headed, and strike prices may sort of surface based on the analysis and how you do it. Let's see. In covered call, the relationship between dividends and the call option. I did talk about that quite a bit. So dividends, they will affect the option because the stock price drops. And I focused on in-the-money options. This is where all the action is when it comes to in-the-money, when it comes to dividends and stocks. An in-the-money option has intrinsic value. That intrinsic value is going to drop with the stock price drop after the dividend goes X or hits that ex-div date. And because of that, a call holder who's got an in-the-money option is going to seriously consider exercising early because they want to capture the dividend. Now, sometimes you'll hear an instructor say, well, if the dividend amount is greater than the time value. I don't say it that way, because if there is any time value at all that the call holder can actually capture, it would be in their best interest to do that. Sell the option, get the time value, go into the stock market, buy the shares, and get the dividend that way. You don't have to give one up to get the other. But let's say you went to sleep, you couldn't watch the market all day. It's after the closing bell. You missed your opportunity to capture any time value, which there likely wouldn't be anyway. But the situation gets a little more clean when you just compare that dividend amount to where is your strike and where is it trading, and am I comfortable buying stock here, or am I concerned about that, and am I willing to give up intrinsic value and not capture this dividend? But you'll see it in the money options right before ex-div, deep in the money options, talking 60, 70, or maybe say 70, 80 or more deltas, they're going to be exercised and assigned. Once you get 55 deltas, 60 deltas, then some will be assigned, some not. It's a different opinion from one investor to the next. What criteria do you use? What does it say? What criteria do you use when you consider rolling out the position versus closing it? The criteria I use is my market opinion. What do I believe is going to happen? So when you roll out a position, what you're doing is you're closing today's open position, maybe for a profit, maybe for break even, but usually when this question's asked, it's because the trade's gone wrong. So rolling out a trade that's gone wrong means you're closing out the existing position for a realized loss. You're booking the loss, and then you're reestablishing a new position in an effort to make back that loss. So what's the criteria? How confident am I in this new position that's going to result from the roll in its ability to recover the losses that I just occurred? That's the criteria. And somewhat of a misconception, I would say, that people tend to think that rolling out means they're delaying a loss. They're really not delaying a loss. what they're doing is closing out a loss and reestablishing something new to try and make it back. And that's really what they're doing. Yes, I talked about some of these things. Did you ever consider a credit spread on the downside in your covered combo? Yes, certainly you can consider that. It would no longer be called a covered combo, but yes, you can cover the downside some way. A couple of questions here. Reach out to eOption. Yeah, if you want some guidance on where to find some trade ideas on the eOption platform, the team at eOption can certainly help you out. Do you ever consider deltas when you determine strikes? Sure. Yeah, deltas can be a nice guide. If you do trades often enough, you may recognize, I'm always selling 30 deltas. I'm always selling 40 deltas. I'm going to kind of target there. Sure. The one thing I'd say about that is I always start with the market opinion. How confident am I? And where do I want the shares? And you have an idea, and then you think, okay, well that's probably going to be a 35 delta. So yes, in some extent, you can use deltas to help get you to a starting point. If you only have one contract in the combo, how can you sell call and put, which requires two contracts? Yes, you're exactly right. So this comment is the combo is actually a strategy that would require you to buy 200 shares. You've got to have the capital for that. If you didn't, then the point of this question is exactly right. You couldn't do the combo, buy 100 shares, sell a call, sell a put, because you need to be prepared to buy 100 more shares. So that is when it really has that added risk element to it, and why I tried to emphasize as much as I could that the real benefit to that strategy is when you are of an account balance and your risk tolerance is such that you're okay taking on 300, 500 or more shares. And you're just going to do it in a different way and buying all those shares and overlaying a call. You're just going to do it differently because you have a higher volume that you're dealing with. And then we have another question here about delta. Do you want it at a 30 to 40%? Do you want to put it 15 to 20%? I think this question is actually more telling me more about their opinion than it is an opinion that I would have. Maybe a 30 to 40 delta call is what you like to sell, and a 15 to 20 delta put is what you like to sell. Perfectly fine to have those kinds of rules in place and structure in place that you use to sell your options. But keep in mind, and maybe as you get more and more experience, you may start to realize, well, I don't have to have these rules because every trade feels different to me. And I want to sell 40 delta because I think the stock's going to hit a massive support level there. But on this other trade, I'm going to sell a 15 delta because this stock is wild and it's going all over the place. I'm going to be conservative. So keep all that in mind as well. So I think Gina, I hit them up pretty well here. I hope the audience enjoyed the presentation as much as I enjoyed giving it. And so I'll give it to you to wrap it up.
Okay, great. Well, thank you so much, Ed. Ed always has a way of explaining concepts to simplify them and is a very popular speaker with us. So thank you so much, Ed. And thank you to all of you attending our webinar today. We know your day is busy and we appreciate you taking the time out to spend some time with us. I know there are a lot of questions that came in. If you do have additional questions, please feel free to send us an email at support@eoption.com and we'll be happy to answer any other questions that you have, or you can also give our trade desk a call. And every person attending this webinar will receive a recording of the webinar in the next few days, emailed to you directly. We also have a library of option trading videos on our website, and you'll also be able to see all of our past webinars there as well. And if you like the content that Ed presented today, if you go to eoption.com, we also have a full library of OIC strategy content there. So we have this great feature I encourage you to check out where it has clickable strategy links. So for example, some of the concepts today, like a cash secured put or a long strangle, you could just click on those items and it'll go through a description, a summary, there'll be videos, motivation, risks, maximum profit and loss. So I encourage you to go and check it out. Again, if you go to our website at eoption.com and go under resources and then education, and it's the very first tab there, option strategy, and you'll be able to check over 100 different strategies there. And as I mentioned in the beginning, we also recently revamped our YouTube channel this year, and there's a lot of new great educational content. So we hope you'll subscribe as well, and you'll be able to learn about specific strategies, spreads, and we also have a walkthrough of our trading platforms. You can learn more about that as well. And if you don't already have an account with us, we hope you'll take a closer look at us. We do offer excellent commission rates. It's zero commission for stocks and ETFs, and some of the lowest commissions around for options, just 10 cents per contract. And someone asked about trading ideas, and we do offer some great tools as well. As I mentioned in the beginning, we offer Options Play, which is a web-based tool that scans thousands of stocks each day to highlight potential option trades for you that meet your specific strategy. And we also launched last week a new stock screener that you can search by over 60 different criteria for stocks that may be of interest to you: dividends, profitability, PE ratio. So there's a lot on there. And also, one of the things we're most proud about, which I didn't discuss, is we have a live expert support team. And what makes eOption different, in addition to what I just mentioned, is that you're not just limited to an app. You can call us and speak to a live licensed broker located in the United States, and our calls are typically picked up in less than 10 seconds. So that's a wonderful feature of our firm that really makes us stand out. And if you still want to give us a try, we do offer paper trading, where you can test our trading platform with 100,000 in virtual currency. So you can give some of the option strategies that Ed mentioned today a try if you want to test out a strangle or a covered call, or even keep watch lists to track your favorite stocks. You can go in there as well and set up a paper trading account. And so that pretty much sums it up. Again, we thank you for your time, and we hope you have a wonderful day. Thank you. Bye now.